So good morning, good afternoon to everyone on this call. Thank you so much
Good afternoon.
Thank you so much for joining our quarterly series. Thank you for joining. My name is Oluwafunmilola Babalala, and I am a staff of Apel. I will be your moderator for this session. Let me give a brief info about our company, Apel, for many of us that don't know Apel. So Apel is an integrated financial service with 5 business licenses running under 3 names. So we have our Apel Asset Limited that covers the stockbroking and corporate finance. We also have the Apel Capital and Trust that handles the asset management and the trustee, and the Apel Capital Registrars that handle the registrars and investor services. So once again, you are welcome to this call. Just for this session, we do not have an hour 15 minutes. We also expect that as the presentation starts, you might have questions. Please feel free to drop it under the chat session. I already have my team on standby who will be reviewing this question, and I promise that we'll take as many as we can. So once again, you're welcome to the quarterly series, the second one for this year. And I must say that there is no other time to review our half year 2 than now. Of course, for half year 1, January to June, we all started the year with restrictions on COVID removed, and we all were excited. None of us expected there was going to be the Russia and Ukraine war. Apart from that, also, we've seen inflation concerns globally, and that has made central bank governors to increase their rates, basically to curtail this war effect and the spiraling prices that also has actually skyrocketed over time. Back home in Nigeria, also, we've seen our CBN governor hike our MPR rates from 11 to 13.5. That's by 150 basis points. We also have seen inflation rate from January to June stating 15.6 to 17.7. Parallel markets FX, we've seen it started with 565, as of now we are on 615, and also our IEI, our I&E window has also lost some naira. We can also attest to the loss in our crude oil production, as of this morning there was a report that says that we lost over $2 billion. And we don't, because we are not sure it is oil theft. We are not sure if it is reduction in production, but this is also happening in Nigeria. Some good news so far for this year. We've recorded solid growth in non-oil exports on a month-on-month basis for 2022. And also in the capital markets in Africa, we have our NGX reporting the highest return so far. That's a 21.3% this year. So even in all this uncertainty, there are good news. And that was why we thought, what next? What do we expect in this half year 2022? We didn't go very far to get an expert. We only went to Lagos Business School and we got Dr. Bongo Adi. So for this presentation today, we have Dr. Bongo Adi. Let me quickly take a little bio on Dr. Bongo. So Dr. Bongo Adi holds a full-time faculty position in the Economics, Data Analytics, and Strategic Business Intelligence Department of LBS. Dr. Bongo is a development economist, a data scientist, a public-private partnership and project finance expert over 2 decades. He has experience in economics research, consulting, policy advisory, and others. Dr. Bongo holds a PhD in regional science and development economics, an MSc in economic development and policy management, under the joint Japan and World Bank Graduate Scholarship of the University of Japan. Dr. Bongo is a recipient of several awards, including United Nations University Fellowship, World Bank Scholarship, Japanese Scholarship, Japan Society for Promotion of Science, and several Best Paper Awards. Dr. Bongo's research has been presented in numerous international conferences, workshops, and published in top-ranked international journals. Dr. Bongo is also a regular economist and business analyst on Channels TV, CNBC Africa, and CNN. He also maintains a column, Bongonomics, in Business Day newspaper. So join me to welcome Dr. Bongo. He would be taking us through the outlook in pre-election year. So I will plead with you to sit back, relax, take your jotter, and let's learn what to expect in 2022. Dr. Bongo, you have the floor.
Thank you very much for me. Thanks for that warming introduction. And welcome, ladies and gentlemen. It's my pleasure and honor to be with you this afternoon. So this is going to be a very short one. The moderator has already intimated some of the issues. In fact, the biggest issue this year, which we didn't see coming into the year. So we'll be looking at that. In fact, this is a year of inflation. So what are we going to be looking at? How will that impact on us? Already we are seeing a whole lot of things happening in so many countries in the world around us. Some countries are at the brink of sovereign default. Many countries, actually, about 19 of them. On that list, as you will see, Nigeria is about number 24. But then you see that there are some other countries that have better outlook when it comes to macroeconomic stability. And then when you consider our own indicators, we seem to actually fare slightly better. Then why is it that we are at a higher, we have a higher risk profile than those other countries? So those are some of the things we'll be looking at. Like I said, it's essentially about inflation in 2022. Now, in 2021, 2020-2021, the issues that we had to deal with, the major one was coronavirus pandemic, of course. That led to a whole lot of actions by several governments to curtail the spread of that pandemic. Now we had the supply, bottlenecks, the supply constraints as a result. And luckily in 2021, within the year, there seems to be a pushback with the release of the vaccines. So that started to reject the confidence in the global economy. So some economies started to really recover. But then not soon after that, we now have Putin's, Russia's invasion of Ukraine, which again, created another turbulence in the world, in the global economy. And from what is going on now, from the point of view of several international economic analysts and financial analysts, it's beginning to appear that what is going on, what the whirlwind that Russia has created may actually undermine the recovery from the pandemic, and in fact, plunge the global economy into a very deep recession. I think that seems to be some kind of consensus, and some of the things that we'll be looking at. Now, and I'll frame my analysis, in questions. I'll be answering 6 basic questions. Like I said, this is about inflation. Now, that inflation, the bulk of it is imported. So, and then our economy happens to be such that we've not managed to build internal resilience, such that we can generate our own economic dynamism much like, say, OECD countries or some other advanced countries. For many commodity exporting countries, developing countries, and emerging markets, it's really very difficult because they are really externally driven economies. And that underlines the importance of the external sector in every economy, especially ours. It used to be said that a call on Nigeria's economy is a call on oil price, and that's very true. So if you look at the transmission path of economic dynamics, you will notice there are four big factors. The first one, of course, is the volume of trade. Okay, what is it that we're exporting and what is it that we're importing? So economists will refer to that as the current account. Okay, so our trade balance is very important, is key, because that is where the resilience, which is symbolized or signified by the external reserve comes from. Then the next one is capital flows. Again, we have to look at the direction of investment flows, whether direct or portfolio. Okay, so where are the investments going to? And of course, you also realize that we've been losing out on this, for many years running right now. Then policies, of course, the policies in the rest of the world. For example, the US raised their rates for the first time in so many decades, okay, as a response to this inflation bout that is ravaging economies. The US is not an exception. So central banks around the world, the Fed leading the pack, resulted to monetary tightening, raising rates. Of course, that is going to have severe impact on the economy, and that is part of the efforts that central banks are making to curtail the inflation surge. Then we have diaspora transfers or diaspora remittances. Now, there are two major things, let's say three, that run our economy. First one is trade, our export, especially of oil. Yes, Nigeria's GDP has grown, non-oil GDP, not non-oil export, actually, because our major export still remains oil. Non-oil GDP has been performing very well, but then we don't export that, meaning that its export potential is quite limited. Then the next one is diaspora transfers. But with rising inflation in the rest of the world, we'll expect that people begin to lose jobs. And then, of course, purchasing power will begin to decrease. So that will definitely undermine or reduce the amount of remittances that countries like us can expect. So when you put all this together, so you now have the external push on our economy, which the driver to whatever happens. So each time that we have any sort of external shock, whether in terms of rising oil price or falling oil price, the impact is felt in Nigeria. It immediately begins to unmask all manner of policies that are just sustenance level policies that the government usually embark on. So, and that has been the case. But what is unusual in this particular instance is that whereas in the past we benefited from rising oil price because our production volume was huge, and we're able to meet our quota. But this time around, it's not like that any longer. Whereas oil price is rising, our production volume has fallen. There is this publication recently where someone says that oil theft has become, it's like a syndicate in Nigeria, and that is really impacting heavily and negatively on the country's foreign exchange earnings. And of course, with that, we are beginning to see that manifest in across filling stations, as the case would be, the cost of gas and all of that. In fact, government is really in a very difficult fiscal situation currently, going by that. So I would mostly dwell on the external environment because that is the source of the turbulence that we're experiencing currently in the economy. And I think that will help us to put things in very good perspective. So first, I look at the external environment, and then we look at the internal, what I regard as the internal effect, how that is playing out in the local economy. So within the economy, we have these actors, what we call the national system of accounts or GDP accounting. Output is composite of government, business, and the citizens. So you have the government spending, investment by businesses, and of course, consumption by individuals within the economy. But of course, the domestic, as I illustrated in the previous chart, graph is driven by the external sector. Okay, our trade, the capital inflow, the remittances, and of course, the policies in the rest of the world. Those are the factors that essentially drive the events or the dynamics or the dynamism of our local economic environment. So it's a time of inflation. We have stagnation, we have debt overhang, and then we have monetary tightening. Now, all these things are coming together. Some pundits are referring to this as, that we are back to the age of stagflation. Now, stagflation, you have stagnant economy that is not growing, and then you have rising inflation, sometimes galloping inflation. Now, what is different this time is that we now have huge debts as well. As you will see, in contrast to the previous era, maybe the 1970s. Now we, in addition to having a high level of inflation and stagnation in the rest of the world, many countries are facing huge accumulation of debt. Okay, and again, recall that the global economy is just reeling from the hangover of the coronavirus pandemic, whereby governments around the world resorted to fiscal stimulus to really keep the economy going during that pandemic, during the lockdown. Now, so there was supply lockdown. There was also loss of aggregate demand, which the fiscal stimulus tried to address. But now it appears that all the ammunitions that the central bank has it's been completely exhausted. And now so many countries are facing very tough situation. So how would that play out? So we said that it depends on the answers to 6 questions. Global financial and economic outlook for the year ahead soared rapidly in recent months, with policymakers, investors, and households asking how much they should revise their expectations and for how long. And I think that is the question, at the back of each person's mind right now. And the reason for this seminar or webinar. What should we do? How do we revise our expectations? What's going on? What will happen? I just wish I could answer some of those questions, but we are really in very turbulent time that the dynamics is so sudden and so fast that it's actually...
Hello, Doctor, are you still online?
Yes, can't you hear me? Hello?
Hello, Doctor. We seem to have lost you there.
No, we can hear him. We can hear you.
We can hear you. We can hear you.
We can hear you.
Okay, great.
Okay,
thank you, everyone.
All right, so maybe you need to check your network because your network shows that it's is in the red. The bars are red. Okay, so how do we revise our expectations? I wish I could answer some of those questions, but we still need to be very careful and cautious because it's so, things happen so fast that any sort of prognosis may actually be, taken over by events. Okay, so the first question is this: will the rise in inflation in most advanced economies be temporary or more persistent? We've seen the impact of inflation. We've seen what is going on in Sri Lanka. Ghana is an African country that is also facing very, troubling time. And also, not just them, they are at the risk of default, sovereign default. Why? What is the source of all of that? Now, this debate regarding whether this inflation bout is a temporary or persistent, phase, the debate has raged for the past year. Now, there is the team, the persistent team. They seem to have won against the team transitory, which previously included most central bankers and fiscal authorities who thought that it was, again, going by the schools of macroeconomics, it's going to be a passing phase, something transitory. But then it seemed from all indications, because if you look at the leading indicators, especially in the OECD countries, you will find out that they are all, they've taken a very sharp drop in recent times. So telling us that, we are facing very sharp recession. So for that, it appears that the analysts are agreed that now that this inflation may persist for some time to come. The second question is whether the increase in inflation was driven more by excessive aggregate demand, that's loose monetary, credit, and fiscal policies, as I mentioned earlier, which governments used to curtail the coronavirus pandemic, or by stagflationary negative aggregate supply shocks, including the initial COVID-19 lockdowns, the supply chain bottlenecks, a reduced US labor supply, the impact of Russia's war in Ukraine on commodity prices, and China's zero COVID policy. Now, why both demand and supply factors were in the mix? What is now widely recognized is that supply factors have played an increasingly decisive role. So not just demand, just by supply. Now, that matters because supply-driven inflation is stagflationary and thus raises the risk of a hard landing, increased unemployment, and potentially a recession when monetary policy is tightened. So these are the scenarios that we are seeing all over the world. Now that takes us to the third question. Will monetary policy tightening by the US Federal Reserve and other major central banks bring a hard or soft landing? Now, until recently, most central banks and most of Wall Street occupied team soft landing. But the consensus has rapidly shifted, with even the Fed chair, Jerome Powell, recognizing that a recession is possible and that a soft landing will be very challenging. Moreover, a model that is used by the Federal Reserve Bank of New York shows a high probability of a hard landing. And the Bank of England has expressed similar views. Several prominent Wall Street institutions have also decided that a recession is their baseline scenario. That is the most likely outcome if other variables are held constant. So we see that in both the US and Europe, forward-looking indicators of economic activity and business and consumer confidence are heading sharply south. Okay, so if you look at this, the top left panel, you have the consumer confidence index for the OECD countries. So there in 2022, you can see that it has taken, kind of bottomed out. Now, compared to other years, that's from 2014 to 2022. So what you see there is 96.5. Okay. Normally, we're not looking at the aggregate value there. What we need to look at is direction, essentially. Now, if you look at the composite leading indicator, which is the composite of the CCI and the business confidence index, much like our purchasing managers index here, you will see also that it is it's taking a sharp drop as well in 2022. Now, if you look at also the business confidence index, you see where it's headed. So looking at these three indices, the consumer confidence index, the business confidence index, and the composite leading indicator, you will really be worried about the times to come. I told myself earlier this year that I will not, say anything negative, but of course, you have to look at the data. And the data from the rest of the world doesn't give us any confidence. Now, I need to reiterate why the focus on the external economy. Nigeria's economy is driven by, in the past, say in 2005, 2006, or 2008, during the financial meltdown all over the world. So that was the time we were in a good position, really, because we by 2005, we had our debt, restructured, almost zero debt as of 2005. You remember the debt relief that was anchored by Okonjo-Iweala and her team. Okay, so Nigeria was on a very good foundation, macroeconomic speaking. And again, we just concluded the banking consolidation in 2005. So we're somehow, not in the position to catch the contagion of the financial meltdown then. But today, our economy has become so globally integrated, okay? And then the lack of diversification of our economy, especially our exports, means that we solely depend on those external drivers for our economic well-being. So it is important for us to understand what is going on and what the implication of this global environment will be for our economy. That is the reason I've chosen to dwell on the external dynamics, because over time, eventually, it will catch up on us. We're already beginning to see that manifesting with PMS, the pump price. From what I read this morning, it seems that the price has gone from 165 or thereabouts to about 200 in the NMPC depot. So that will give you some indication of where the direction we're headed. The fourth question, remember the first question, whether the inflation is permanent or temporary. Now, the fourth one is whether a hard landing will weaken central banks' hawkish resolve on inflation. Now, if they stop their policy tightening once a hard landing becomes likely, we can expect a persistent rise in inflation and either economic overheating, that is above target inflation and above potential growth, or stagflation, that is above target inflation and a recession, depending on whether demand shocks or supply shocks are dominant. Now, most market analysts seem to think that central banks will remain hawkish. Now, if central banks are hawkish, what do you think will happen? Now, that takes us to question 5, with a hard landing becoming a baseline for more analysts. Now, a new question is, will the coming recession be mild and short-lived, or will it be more severe and characterized by deep financial distress? What analysts seem to believe is that it will be shallow and brief. That's some analysts believe that it will be shallow and that it will be brief. The reason is that today's financial imbalances are not as severe as those in the run-up to the 2008 global financial crisis, and that the risk of a recession with a severe debt and financial crisis is therefore low. But I think this is way off the mark. Why? If you look at the global debt, it's approaching $300 trillion. $300 trillion. That is the bulk of debt in the world today. Okay, so what does that tell us? There is ample reason to believe that the next recession will be marked by a severe stagflationary debt crisis. That is, we have high inflation, then we have stagnant growth. I'm happy that Nigeria has posted, above 3% GDP growth in the last quarter of 2021. So again, GDP growth is not a forward-looking indicator. It's not a leading indicator, rather it is a lagging indicator. It tells us where we are coming from. It doesn't tell us where we are headed or where we are. So the data on GDP that we have actually told us what happened before the Russian invasion of Ukraine. So I believe that by the time by the next quarter, then we have the first quarter GDP for 2022. Then that's when we'll begin to see, even not then, it will be much in the second quarter. Okay, that when we have the data for the second quarter that just ended, that's when we'll be in position to really know what's going on with our economy. But do not forget that the data on the GDP that we have, which has shown that we are in the green, that we are growing 3%, which of course is still low, given our target and our priorities. The population that we have, the demographic challenge, the unemployment situation, is still nothing to write home about, but at least we are growing. But do not forget, it is telling us about the past. It doesn't tell us where we are. It is a lagging indicator, not a leading indicator. It doesn't tell us where we are or where we are headed. So that is why we have to be looking at the Purchasing Managers Index and all of the leading indicators. Now, as a share of global GDP, private and public debt levels are much higher today than in the past, having risen from 200% in 1999 to 350% today. Okay, with a particular sharp increase since the start of the pandemic. Remember, a lot of bailout countries going and borrowing, Nigeria not left out. Under these conditions, rapid normalization of monetary policy and rising interest rates will drive highly leveraged zombie households, companies, financial institutions, and governments into bankruptcy and default. Of course, we're beginning to see that. I don't know if anybody, so I know that some people play in the crypto market. So crypto is now being seen as a bubble asset, and so many of them, like Luna, have completely, been decimated by the economic situation. And Bitcoin, okay, one of the stable coins, the original, crypto, has lost huge value. I mean, I wouldn't be talking about that, but you know what is going on with the crypto, market as it is right now. That people are beginning to think that was it like a kind of, a scam or a Ponzi scheme. That is the situation. I think it's not about crypto or those assets being a scam or whatever, but it's just because of their leverage. Because the cryptos were actually, they take money from people, invest, buy some assets. And then people now borrowed against their crypto holdings and all of that. Now with interest rates going up and inflation going up, what the consequences. So people are quickly moving away from those assets, dumping them. I think that is actually what is going on. So which again plays into this picture, okay? That what we have today is a completely different scenario from the past. So we have, in addition to having a stagnation and inflation in the rest of the world, we also have high debt levels. So that high leverage is a big problem. So the next crisis will not be like its predecessors. In the 70s, there was stagflation, but no massive debt crisis because debt levels were low. Note, in the 1970s, there was stagflation, but no massive debt crisis because debt levels were low. After 2008, there was debt crisis followed by low inflation or deflation. So there wasn't inflation. There wasn't an inflation risk in 2008 because the credit crunch had generated a negative demand shock. So low aggregate demand, okay, that drove prices down. That's 2008. Debt crisis, but low inflation. 1970, you have stagflation, but then no massive debt crisis, okay? Then for these two, we had kind of a short-lived recession. Contrast that to the current reality. there is potential supply shocks in a context of much higher debt levels, implying that we are heading for a combination of 1970s style stagflation and 2008 style debt crisis. That is a stagflationary debt crisis. So what I see and what we're looking at is a combination of the 1970s and 2008. In the 1970s, you had an economy that wasn't growing and inflation. That's the rest of the world, using the US economy as an indicator, as an index. Then in 2008, we had a situation of, low inflation, but then there was debt crisis. Today, we have a combination of both, stagflation and high debt, overhang. So we have a stagflationary debt crisis. Now, when confronting stagflationary shocks, what does the central bank do? It tightens its policy stance even as the economy heads towards a recession. Now, the situation today is thus fundamentally different from the global financial crisis of the early months of the pandemic, when central banks could ease monetary policy aggressively in response to falling aggregate demand and deflationary pressure. The space for fiscal expansion, however, will also be more limited this time, because most of the fiscal ammunition has been used up and public debts are becoming unsustainable. Moreover, because today's high inflation is a global phenomenon, most central banks are tightening at the same time, and just as the moderator said, thereby increasing the probability of a synchronized global recession. This tightening is already having an effect. Bubbles are deflating everywhere, including in public and private equity, real estate, housing, meme stocks, crypto, SPACs, there are special purpose acquisition companies, bonds, and credit instruments. Real and financial wealth is also falling, and debts and debt servicing ratios are rising. We're beginning to see also high spread, rising spread between treasury and bonds. So that will bring us to the final question. I'll leave you to really make up your mind where you think things should be going, because sometimes if we were in 2005 or 2006, I would say, okay, we don't need to worry. Our economies are not that fused into the global financial architecture. Of course, we can no longer say that. It's still a good thing that our, the stock market is still, showing signs of life. We haven't seen, the kind of the hemorrhage that is going on in the rest of the world. That hasn't started to manifest in our own stock market. Okay, but I think that leaves also something for us to think about. Whereas, given the level of insecurity that we still have, our equity market still, stable in a pre-election year. All right. Usually, what normally happens is that any pre-election year, you have a huge hemorrhage on the stock market. But that doesn't seem to be the case right now. But I think I'm not praying for it, but we're still, some months away from that. Now, so because today's higher inflation is a global phenomenon, most central banks, like I said, they are tightening at the same time. As a result, we have seen assets beginning to, the popular assets being deflated everywhere. And then the final question, will equity markets rebound from the current bear market in the rest of the world? A decline of at least 20% from the last peak, or will they plunge even lower? Most likely they will plunge lower. After all, in typical plain vanilla recessions, US and global equities tend to fall by about 35%. But because the next recession will be both stagflationary and accompanied by a financial crisis, the crash in equity markets could be closer to 50%. Now, regardless of whether the recession is mild or severe, history suggests that the equity market has much more room to fall before it bottoms out. In the current context, any rebound like the one in the last 2 weeks should be regarded as a dead cat bounce rather than the usual buy the dip opportunity. though the current global situation confronts us with many questions, there is no real riddle to solve. Things will get much worse than before they get better. Okay, so that is the poser, and that's the background. For now, let's look at the domestic economy, what's going on. I'm also taking out the question to see if people ask a question that I can address now. We've pointed the issue in the rest of the world. Now let's look at the internal effects or the domestic effects. So the 6 questions, all about inflation. Inflation leading to a recession. Now, would that be short-lived or will it long for a while? Our conclusion is that we have high debts in the rest of the world, high public and private debts, more than $300 trillion at the moment. And then we have stagnant economies around the world and inflation. So when you put these 3, and of course, monetary tightening, these 3 factors will not happen without affecting us. So whatever we are doing now, okay, we're not praying for the doomsday, and I'm not predicting any doomsday, but if the indicators are anything to go by, definitely it's just a matter of time before we begin to reel from the shocks coming from the rest of the world. Already the inflation is being imported. And honestly, if you want to read more about inflation, the impact, I don't want to share that. The LBS Breakfast Club, Bismarck Rewane, the presentation he made at the Breakfast Club last Wednesday, okay, captured that succinctly. Even though we are reporting 17, the official inflation figure is about 17.something%. But you and I know what it is. That's really underreports the inflation, the actual inflation in the market. Some analysts will tell you that it's above 80% inflation. So we're already having that. And of course, you have an inflation. This central bank has tightened the monetary policy from 11 to 11.5 to 13%. And then this is a pre-election year when definitely there's going to be kind of a surge in money supply. So we expect that that's the next monetary policy up until the end of the year, they will keep tightening. And as that happens, interest rates will overshoot. With interest rates overshooting, now you can guess what the implication would be for investors, okay, and SMEs, and even household for consumption. Africa is currently drowning in debt, up 16-year high. Africa is borrowing too much money at too high rates. A third of the debt is from foreign creditors, accounting for 55% of interest payments. So the defining thing in my presentation, okay, are the inflation, okay, and debt. So the combination of this, which is what is triggering the monetary tightening by central banks all over the world. Okay, so where is that going to take us? Where is it leading us to? I think that will summarize everything happening around us. Yes, our economy is showing signs of growth. Like I said, the data is of the past, it's lagging. It doesn't tell us what has happened. All of this, nobody saw, just as no one saw the coronavirus coming in 2020. No one also saw the Russian invasion of Ukraine, which is actually the source of all of this. Now, how long will that last? But we cannot tell. What we are sure of that is that the deed is already done. Now, for African countries, huge debts, high debts at high interest rates. Third of the debt is from foreign creditors, accounting for 55% of interest payments. Chinese debt is about 20%, which account for 17% of interest payments. Now, the irony is that poor countries are forced to raise even more debt in order to meet repayments and existing debt. In other words, countries are restructuring their debts. Debt servicing has become much like borrowing to pay back debt. So further, sinking into debt, much of which is denominated in US dollars. And as the greenback increased in value as a safe haven during the pandemic, the burden of repayment has only mounted. So we know what the debt situation is for Nigeria. That I do not need to re-emphasize that. Okay, so this is from Bloomberg. Bloomberg terminal, you will see the rising sovereign default across developing and emerging markets. You see the sovereign debt vulnerability ranking, lower rank, higher risk. So if a country such as El Salvador is the most harmfully impacted, as the highest risk, followed by Ghana at number 2. Right, so Ghana, when you look at the government bond yield, 17%, okay, 5-year credit default swap spread, that's in basis points. You can see how big that is. It's about 271% or 200%. That's 2,000 basis points. Then interest expense in 2022 as a percentage of GDP, 7.2%. Then Ghana is followed by Tunisia. Okay, its common bond yield is even higher, 32%. And you can look at it, that's number 3. Then Egypt, African country, is number 5. So yeah, in some few weeks ago or 2 weeks ago, somebody visited Egypt, and then I think I listened to some conversation. I mean, to the Channels TV or Arise TV interview, where Egypt was being praised for some of the things they've done in infrastructure. But here it is, Egypt is also facing the risk of defaulting on its sovereign obligations. Then you have Kenya, right? So that when we make comparisons, let us be sure that we have the right information. We've got Kenya there. So even Rwanda is at a higher risk than us. See Senegal, Angola. Now Nigeria comes at number 24. Now our government debt is not actually, as a percent of GDP, is in the green, right? I've always said this. I know that people come after me, but I really don't bother. I don't have any problem with borrowing. I keep saying that. But what I have problem is the utilization of the borrowed funds. What are we doing with the monies with the funds that we borrow? Okay, if we can judiciously and effectively, accountably, transparently use the funds that we borrow, I think we'll be transforming this economy. As it is, we are not in a bad shape. I mean, this is Bloomberg, by the way, not my own data, not my own fabrication. So in terms of sovereign debt vulnerability, yeah, we are number 24, like, halfway. So, but then let's look at countries that are better than us. Say Romania. Romania, its bond yield is 6.1%. Nigeria's is 12.8%. That's huge. Again, I think that reflects the security concern or the security or risk or premium. And then its 5-year credit default swap is 292 basis points. Now contrast that to Ghana's, that is 2,000. Then Nigeria is 990, again, which is huge. And then its interest expense is 1.6 as a percentage of GDP. Nigeria's interest payment is 2.3 as a percentage of its GDP. This is 2022 data, by the way, current. And then let's look at interest expense here. Gross government debt 2022 as a percentage of GDP. Romania's is 56% debt. Nigeria is 37. Okay. Mexico, that is even better a little bit in terms of that risk profile, is 58 in terms of their debt to GDP. So you see that, yes, people, we keep saying that we borrowed so heavily and all of that. Perhaps there's some bit of propaganda there. This data should tell us the true situation. Like I said, I didn't make this up. This is from Bloomberg Terminal. If you know how to use the terminal, you can, or if you have access to the terminal, you can query the terminal and get this information. It's all there. So yeah, there are some countries that are doing so well, but again, I am not a believer in debt to GDP because I think it's a lame statistics. In my column, Bongonomics, I took a swipe at GDP, debt to GDP ratio as a lame indicator because it doesn't tell you much, right? So perhaps rather than that, we should be looking at the government yield. I mean, government bond yield, which is what will give us some good indication of where we are, right? Ethiopia is, all African countries, you can see where they are. Ghana is 17, Nigeria is 12, Ethiopia is 33.9, almost 34%. Yeah, Gabon is 11, which other African country is low here? South Africa, 7.3. So that is it. This is the rising sovereign default across developing and emerging markets. 19 countries are standing at a decrease. That's from El Salvador to Ecuador. Okay, Nigeria isn't there yet. Okay, but is there any likelihood? What are the odds that Nigeria will escape? Or what are the odds, as my students will always say, what's the probability that Nigeria will be, will also rise, I mean, in terms of vulnerability to sovereign debt default? That's a possibility. The last time, I think, was it last week? Last week, the Euro bond, right? I think was put off because of investors were expecting higher interest. Oh, okay, Nigeria was classified as a junk status. So we may be heading there. Again, is there anything that we need to do internally? Is there anything that will have to happen in the short run in order to avoid such situation? It's difficult to tell because this is a pre-election year. Right now, what government is preoccupied with is the next election. So you can, of course, we're already seeing that governance seems to have been put on a hold for now. So I don't expect much to happen between now until the next government comes in. So we just be coasting. What is happening right now, I'm happy that our external reserve has, has experienced positive accretion in the last month or so, as a result, of course, the high oil price. But of course, subsidy on fuel, on fuel will eat up all of that at the rate it is going. We do not know what's going to happen with oil price. If it keeps going up as it is, with inflation going up, Russia unrelenting, there's a possibility that oil price will keep going up. In the past, if oil price is going up, we'll be smiling. That doesn't seem to be the case any longer. The high oil price means that we will begin to have problems with supply of those of fuel, because we do not refine them at home. We have to import. Okay, so this is the situation again, local situation, deteriorating macro stability index, which is this is from the World Bank, right? So the combination of inflation and the external and fiscal balance, see that Nigeria is underperforming below sub-Saharan African average, okay, since 2008 anyway. So that's not just recent, right? So these are some of the indicators. We have inflation, which is going up, Nigeria, but we've seen credit spreads. Nigeria is going up, now matching Angola's. Before, Nigeria used to be kind of very, very low, 500 basis points. As you can see, we have 990 basis points. So we now match Angola. All right, so the good news, the GDP growth, 3.1. That is Q1 of 2022. We have 3.1 GDP growth, 3.9 last quarter of 2021. At least it's positive, but is it something that we should be happy about with the high level of joblessness in the economy? I don't think that that is enough. So we should do better than that. But of course, you know what the mitigating factors are. Now, non-oil growth, non-oil GDP performs oil GDP for obvious reasons. You know what's going on with oil price. Oil production volume. So non-oil GDP has been going up, but that has not translated to exports. It's important for us to note that our major export still remains oil, except we develop our export market, which is a more complex conversation that needs to happen, okay, across board. Then we don't expect anything to change. Yes, our GDP will grow. That's fine. We can feed ourselves, but then to really have the sustainable economic foundation and structures, it is important to develop the export market. So this is agriculture. What has happened to agriculture, despite the disruption in the northern part of Nigeria, agriculture has remained resilient over the years. Okay, the industrial sector, including manufacturing, construction, water supply, okay, still in the red. Again, this is the one that has very huge export potential, at least within our West African neighborhood. We should be supplying some manufactured product, exporting some manufactured product, but that is not happening. So you can see that manufacturing is still in the red. We're lucky at some point, first quarter of 2021, it came out. So, but that seemed to be the only positive spot that it has had since 2020. Okay, so still very much in recession. We define recession as 2 consecutive quarters of negative GDP growth. So we have had, okay, it didn't grow at all in the fourth quarter of 2021. So if we look at this, it's been 4 consecutive quarters of negative growth in the industrial sector. This is the industrial sector. That is what creates the major employment. That is where, what drives consumption and what drives aggregate demand. Services sector, of course, is growing. Services have little or low, export potential. So what are the sectors that are driving this? We have trade, ICT, good, real estate, good, finance and insurance, always finance and insurance. Out of the 23 activities in the services sector, 21 subsectors expanded, while 2 activities contracted in 2022 Q1. So services doing well. But services, apart from real estate and ICT, I think they really is not really the growth that we expect. So if you put those together, the growing sectors, the most growing sectors, rail transport and pipeline, air transportation, metal ores, financial institutions, as usual, telecommunication, water supply, chemical and pharmaceutical products, food, beverage, and tobacco, cement, transport services. Then the contracting sectors, we have textile, apparel, and footwear, pulp, paper, and paper products, basic metal, iron and steel, electrical and electronics, electrical supply, coal mining, quarrying and other minerals, road transport, crude, petroleum and natural gas, oil refining. Okay, so that summarizes the internal realities, the internal effect of the global dynamics. But I said earlier that we haven't yet arrived at the point where we begin to experience the impact of what is going on globally right now. It's going to be this quarter, at the end, once the second quarter result is out, we'll now begin to see the effect. But for now, what we're seeing is just the effect of the, as the economies got out of the coronavirus pandemic, the supply constraints eliminated, economy started to rebound, okay? Because all those bottlenecks were removed, and then aggregate demand started to rise, and then we have supply. So definitely every economy started to rebound. That Nigeria was not an exception. But then with this new surge of inflation, debt is not a big problem for Nigeria as it is, as you could see. Our debt to GDP ratio isn't really that bad, okay? Yes, we have problem with revenue, and then we have problem with debt servicing. But even at that, we see that our debt servicing in 2022 as a percentage of GDP, except there is something wrong with that data, is still below 3% or thereabouts. So we shouldn't focus on that. What is the real problem that we're having in the economy today? Where are the sources? What is this real source of our, the joblessness and the low growth that we are recording in the economy? I think it has to do with policies. The chief of them is a subsidy. A subsidy is number one. The second one, of course, the exchange rate. Okay, I think it's about time to allow the harmonization of the exchange rate. What normally happens is when a country adopts a flexible exchange rate regime, initially, that's what we call the J-curve, okay? Yes, the country's currency will become, will depreciate, but over time, the market forces will ensure that, there is a little, a level of equilibrium in the market, and then things will normalize, and then begins to appreciate over time. Of course, guided by a determined government policy. That needs to happen. And I'm not just saying it, I think we've heard that from the IMF, we've heard that from the World Bank. The IMF actually blamed the central bank for causing some of the hardship that we've been facing because of its interventionist approach, especially in the foreign exchange market. Okay, so that doesn't give any sort of confidence to investors, and we've seen a whole lot of disruptions that has caused. In this election, pre-election year, we expect that anything will happen with the subsidy be removed. Of course, the government in power will not want to do that, not at this material point in time. So we'll expect that the subsidy will still be in place. Central bank interventionist approach in the economy will continue. If there is going to be anything, it will be from next year. But for this year, I think things will continue the way they have been. So we'll be at the mercy, and this is me speaking, we'll be at the mercy of the international dynamics. Okay, so obviously, if the predictions that we have, the picture I've painted earlier, if it comes to pass, then Nigeria definitely will be hit hard because we will import all of that scenario, given that we are now integrated into the global economy and we will not be immune to the contagion. So ladies and gentlemen, that's where I will keep it for now. Yeah, there are some questions. I know that you expect me to speak about the stock market and a whole lot of other things. That will be on a different fora, you know, but for now, this is what I have prepared for today. To review the economy, then, you know, look at where the economy seems to be headed. Thank you very much.
Thank you so much, Doctor. And I must say that even though you took most of the time, it was quite an in-depth research, and it was interesting to a number of us, of bad news. And I think that's the reality that you have set you know, ahead of us. Like the topic stated, what do you expect for a pre-election year? So Nigeria seems to be quite peculiar, looking at the election period and looking at the double whammy of inflation that you have told us about, and also the sovereign default. But I must say that the good news I was able to note is that Nigeria is less on the default list of their borrowings. And so that's a little assuring. So we have a number of questions here. I'm sure we can only take a few of them, like we promised earlier that we wouldn't be taking a lot of the time of those connected. So I will start with Jerry N, who says that, do you think the global inflation would have happened with COVID alone, or was it the Russia-Ukraine war that led to that? The second part of it, Doctor, is that, is there a likelihood that this stagflation or this threat of recession will end if this war ends? Thank you.
Okay, yeah, so that's Jerry. Do you think the global inflation will have happened with COVID alone? Yes, now, but it wouldn't be at the level that we're experiencing. You know, one of the economic principles is that you know, a society faces a short-run trade-off between inflation and unemployment. Now, what that means is that when an economy is growing, there is a certain level of allowable inflation. Of course, once there is stimulus, economy is being stimulated, you definitely will have you know, certain level of inflation that is actually enhancing growth. So it's a positive boost, sort of a tailwind for economic growth, a certain level of inflation. That could have happened, but not at the level that we have it now. What has worsened the inflation situation, that is taking it off the growth phase, is the Russian invasion of Ukraine. What that's exposed is how much the global economy is still dependent on fossil fuel. Despite all the claims about renewable energy and all of that, you could see that it will still be a long time before the global economy wins itself from fossil fuel. That's why I don't really buy into all these things about sustainability. Yeah, sustainability is good and it's something that should be pursued. But then all these things are determined by technology. It is technology that takes the lead, and it is technology that will decide what is sustainable and what is not. As it is today, the production technology, manufacturing technology is still, you know, when you talk about heavy manufacturing, okay, as that takes place in much of the OECD countries, it is still heavily dependent on fossil fuel, okay? And then you know the position of Russia in that energy mix. So that is what has worsened the inflation situation. In fact, it is the Russia-Ukraine war that is plunging the global economy into a recession. That's simple. Now, is there a likelihood of existing stagflation on a short term? I think I've answered that question. If you go through my presentation, you see what I said. It's not going to be a short-term thing. Yeah, that likelihood is very low. Why? Because it's not just about inflation. We are facing a huge debt overhang. Now, begin to note that asset bubbles, okay, are deflating. Look at what is crypto is an indication, right? Real estate is facing that situation. and so many other sectors, So when you look at that, you can conclude that, yeah, it is going to be short lasting. I mean, again, I cannot say that I'm not a prophet, right? I'm only acting on the data. If you look at 1970, the situation in 1970 was high inflation, okay, and stagnation, but there was no debt crisis. The situation in 2006, 2007, 2008 financial crisis, we had a debt crisis, but we had low inflation, okay? But today we have high inflation in the rest of the world, stagnant economy, that's stagflation, in addition to huge debt overhang. So the combination of these three forces, and then the central bank tightening as well, because this also has a recursive effect. So the recession, if it happens, will definitely not be short term. Okay, what will be the investors' reaction towards the government bonds? Yeah, so equity market, Nigeria is still holding firm. The spread is widening. Okay, so when spread is widening, that tells you that people are already that people have preference for. Yes. Hello.
Hello, doctor.
Yes, I can hear you.
Thank you for that explanation. Yes, we can. So I have a number of questions on the areas investors should be looking at. So I want you to take it together. Some want to know, should they be doing equities? Should they be doing fixed income? Should they be government bonds? So I just want to take all.
I don't know if it's on a network or mine. I could barely hear you.
Okay. Hello, doctor.
Yes.
Can you hear me now?
Yes, I can hear you.
Hello, doctor. Yes, so I said there were a number of questions around which area of portfolio should people be looking at? Should they be looking at equities? Should they be doing fixed income? Should they be government bonds? So I want you to actually have 2 minutes to discuss on what people should be looking at.
I don't want to, sorry, please. I'm sorry to disappoint you. I don't want to offer any sort of investment advice. Okay, so if you want me to speak specifically to that, perhaps it's something that we can take off, but I don't want to offer any sort of investment advice. But, what is clear is that the spread is widening, right? So meaning that people are moving away from equities, okay, into more secure government instruments, right? So, but again, you have countries that are, Nigeria is not yet in default, not yet. But what needs to happen for Nigeria to get into that league of defaulting or high risk sovereign vulnerability risk profile? We have seen our credit defaults swap. Okay, the spread is rising. We're now matching that of Angola. That will tell you something. We look at our debt to GDP. Yeah, someone asked the question that I cannot speak about debt to GDP without talking about revenue to debt service. Of course, I mentioned that. I said that we have a problem with revenue, but again, does it mean, can't you borrow money? Like you have, let's say you have some idle assets, right? This is how I think. Okay, but forgive me. If you have an idle asset that needs some infusion of capital to put it back to life and to get it to production and increase productivity, why not? So you can borrow money and plug it into that asset, rejuvenate the asset, get into the market, get it producing. And then over time, you will now be able to pay both the old debt and the new one that you've contracted in order to get the asset to work. So there is nothing wrong about that. Okay, so yes, we have a revenue problem, but that does not mean that our debt to GDP ratio is high. That should, I mean, you can see the data there. We are not at we are number 24 out of 50 countries, right? So I'm not saying that, yeah, they're 19, 1 to 19. So we still have 5 steps to go, but not much needs to happen before we get there. But we still have some good indicators. So our debt to GDP is in the green. Okay, so that's what the data says. It's not me. Yes, a lot of people worry about our revenue, debt service, and all of that, that our independent, government independent revenue, all of it, 90%, I've had P2P and some others use that a lot of time. Yeah, you can, but again, if we had better monetary or, monetary management, I think we'll not be where we are currently. I'm happy that the CBN, the IMF, the World Bank, and some other international development institutions have pointed out what we have been screaming about for a couple of years now. So many things I didn't come here to criticize the central bank. So if you want to hear me out on that, maybe in another forum, but not here publicly. And moreover, my immediate boss is also part of the government, and I know that he's doing the best he can. But sometimes there is some level of inertia in government that you can also be an outsider in the government in which we're part. So we need to be careful when we talk. Thank you. Yes, Ma. I think that's the much we can. But if you have any questions,
thank
please,
you so much.
I will take care of those questions.
Thank you so much. Yes, sir.
Thank you.
Yes, sir. So that's what I was. In fact, we've gone far above time. So I wanted to say that for those that have questions on investment, we will be reaching out to them because, as I earlier introduced, Apel is an integrated also to guide you, to guide your financial goals, financial objectives, even in this season of uncertainty. Doctor has been able to let us know that there is time for everything, and now we need to exercise caution, particularly because of the pre-election year that we are in. So in as much as we say that in time of challenges, there are opportunities. So we'll be happy to guide you through that. So we do not waste further time. Let me thank you all once again for joining this session. It was really to continue to hope more in Nigeria, even though we have the overhang. So Doctor, thank you for your time. Thank you, everyone. I must say that we will be reaching out with the recording for those that also were not able to join. For those that want to refer that, we also will be letting you know about our social media to us for questions. As mentioned earlier, we will be sending you responses for the investment questions. So thank you so much for your time today. It is a quarterly session, and we expect that we'll reach out to you again for the next quarter. We will have you at the next session. Thank you for your time today. Staying longer than we planned. Everyone, thank you, Dr. We surely be reaching out to you for that. So thank you all for joining once again. Apologies for the network issues, but now we are at the end of the session. Thank you so much. Thank you for your questions. We'll reach out to those that we were unable to answer. And we also would want you to know more about us. So be sure that the email address you have dropped, we will introduce ourselves to you. And then we will be sharing with you investment opportunities like you all want to know. Thank you so much. Enjoy the rest of your day.
Thank you, everyone.
The rest of
Enjoy the rest
Thank
of the day.
you so much. Thank you, Doctor.
All right,
bye for now.